don't be intimidated by this 150-page document that you've got, because essentially at the heart of it, there's a story about what the investment strategy is and what the manager is going to be doing with your money.
Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time.
Hello, everyone. Welcome to Alt Investing Made Easy. Today, we continue to take a deep dive into the subject matter we covered in our first episode, Intro to Alternative Assets. Today's topic is about due diligence basics for investment opportunities. We hope you find this level of detail useful and interesting. Roland, do you want to take it forward and introduce the terminology?
Yeah, for sure. And just to let everybody know, this is us in our roles as attorneys. We represent investors, and today we're taking this from the perspective of an investor that's investing in private securities, and we're going to be going through really the documentation, the things that you should be requesting from whoever is asking you for your investment dollars. These are the documents that you want to see, and how we would advise you to look at the different parts of the documents. And so in connection with this, we do want to let our audience members know that this doesn't constitute legal advice or investment advice. We need a actual agreement in place before we could take that responsibility on. But, this is education, and we can speak in general terms. And we also do offer all our audience members a free consultation to talk with us about the topics that we're discussing today, or anything else that we talk about on Alt Investing Made Easy. So, Sarah, I'll get into this. We're going to be, again, talking about the documents that you as an investor would want to request from a fund manager, an investment manager who's sponsoring a private securities offering. And like we said, we talk a lot about commercial real estate, but what we're talking about here today really applies to any private securities offering.
Exactly. And so we want to take you through some key terms. We'll talk about them in a bit of detail here. And probably they're familiar, but sometimes it's useful to hear them just listed out. So the first one is the Private Placement Memorandum, which we also often call the PPM. Roland, what's the Private Placement Memorandum? What is it and what's it for?
Well, what's so important is to remember what the disclosure obligation is of the manager. And we talked about it before, but as an investor, this is what you really should expect from the investment manager, whoever's sponsoring the deal, is they have an obligation to tell you about all the material information about the investment so that you can make an informed investment decision. And they can't fail to tell you anything where the failure to tell you the information is also, would be material. And so really, the PPM is the disclosure document. And at heart of that, really, when I think about this, is the investment manager is telling the story behind the investment. They're telling you as a potential investor, this is what's going on. This is why you're investing. And so first off, I would really encourage everybody to don't be intimidated by this 150-page document that you've got, because essentially at the heart of it, there's a story about what the investment strategy is and what the manager is going to be doing with your money. And if you can't ascertain that relatively quickly, then it's not your fault. It's the investment manager's fault, because they have an obligation to disclose this, and they should have a personal interest in being really clear and concise, and making sure that anybody that's investing money with them understands what's going on in connection with the investment.
So this is really critical. And we talk to clients a lot about how, on the one hand, you might get a pitch deck when an investment comes your way, and that can be called a number of different things. It is usually incorporated into the private placement memorandum. but it likely is not sufficient disclosure. And so, in a deal that's good, the private placement memorandum should be offered up freely, or at least to a confidential, list of people. But it is not just limited to an investment summary or a nice pitch deck with information and, some performance numbers and things like that.
Yeah, hence the length. I mean, we're telling the story, but there's really the smart managers will know that they need to include all the risks in there, and that can fill up, a good 10 pages of the document.
And those are risks that investors need to know about too. So they're super informative. And obviously, it's incumbent on the manager or the promoter of the deal to be explicit with all material risks. However, an investor with enough experience, or even from the beginning, you might notice that certain things are missing. So it gives you a chance to also ask some questions. And that's really, Roland, we were just talking about how one of the fundamental parts of doing any kind of deep due diligence is being willing to ask probing questions. And we'll get to that a bit when we talk more about the manager. But it really applies to the materials also, doesn't it?
Yeah, absolutely. And don't be afraid to ask questions. And even if there's a 150-page document in front of you, it's possible that the manager left something out, either intentionally or accidentally. So don't be afraid to ask questions. Exactly.
Now, another thing that's important to find in the private placement memorandum are the investment terms and the use of proceeds. The investment terms are related to what the investor expects to get out of the deal. And the use of proceeds is what the investor would expect the promoter or the manager to do with the money that they put into the deal.
Yeah, that's right. Two of the most important sections. And if you're really, that's the heart of the story is, what are you going to be doing with my money and how are you going to be paying me back?
Exactly. So these are all parts of the private placement memorandum, and they're usually quite organized and follow a typical format. There could be slight variations on this. And always there's a summary section, isn't there, Roland, where you should be able to turn to have a quick look if that's what you want to start with and see a summary of all of the main terms that are included. And then much longer sections, of course, on the risk factors and the details of everything that's contained in the summary.
Yeah, that's right. And again, with this, put yourself in the manager's shoes. It's in their economic interest to tell you the complete story in a really concise way that's immediately understandable. Sarah, before I forget, this is the one thing that I wanted to bring to everyone's attention is that if you are ever considering an investment and the person that's the deal sponsor resists disclosing any information to you, or they get offended that you're asking so many questions, that's a giant red flag because as we mentioned a couple times already, it's in their interest to disclose to you what's going on. And if they fail to, then there can be a fraud claim that can be brought against them in the future. So
exactly.
That's just one thing that, I've heard that from people before. And there are some instances where a manager may withhold information if it's proprietary, but they should be able to tell you that, hey, that's our proprietary hedge fund trading strategy. And while we're going to give you a general overview, we're not going to disclose the computer algorithm that we use to, assess the current market condition, but they have to describe it to you in adequate detail so that you can evaluate. And maybe if you're super sophisticated, then you do, enter into some kind of non-disclosure agreement and get somebody to evaluate their code or whatever. But in any event, that's the point, that the manager should understand their obligation to disclose.
Exactly. And the disclosure should be, in the form that's pretty substantial, not simply a pitch deck. And that's, I think, something important too. The pitch deck is the beginning of the disclosure, right?
Yeah.
It's not the end. So, well, what's another agreement? There's the operating agreement, or sometimes it would be a company agreement that also usually comes with your investor pack.
Sarah, tell us about what the operating agreement is.
So the operating agreement is actually the contract that you as an investor have with the company, and the manager is a part of the company, and then other investors are part of that same contract. And so the operating agreement should reflect the economic terms that have been disclosed to you as the economic terms of the deal for the investor. So those definitely are there. There are also governance provisions, which are the details of what the manager can and can't do, who has the authority to make certain decisions about different things, and matters like that, which are important for the investor to understand, because very typically the manager will have all possible powers to make all of the decisions in respect of the investment, which is also not necessarily a bad thing because the manager needs to be able to act quickly and take decisions. So, but that balance of decision making between investors and management is an important governance topic to understand.
I like looking at the operating agreement for those governance provisions, because it's pretty easy to determine, and then also the summary and the PPM may gloss over particular details. So I would encourage everybody to really, scour the operating agreement, learn how to read these, and pay particular attention to how the money's coming out again, and what these control provisions are.
Exactly, including such as making an amendment to the operating agreement itself. Capital calls is another important term to watch out for in that agreement. And generally just member rights. But and there can be other things in there. There are usually, details about tax matters and what happens, if there needs to be an exit. So there are a lot of important details, and this document is not quite as long as as a private placement memorandum, but it is like the more, you could say, a technical legal document in the sense of a contract. That said, I think we always encourage our people to make the effort, like Roland said, to read these. Don't be intimidated by them. You can understand them. Just need to take the time to get through it, and it's very important for understanding what your actual rights are, where you could actually enforce legal provisions in your benefit if you needed to.
That's a good summary, Sarah.
So you want to talk about the subscription agreement, Roland?
Yeah, and this will be included along in the package that you get. And this, it used to be set up kind of as a questionnaire that you would fill out by hand, but I think more and more people are doing it electronically now. But, the investment manager has to get information from you as an investor. They've got to get your identity information. They've got to get your social security number, because at the end of the year, they're going to be issuing a K-1 to you or a 1099. So they need your personal information, and how to report the economics of the deal to you, with respect to your either social security number, or if you're investing through an entity, your EIN, employee identification number, or tax identification number, it's called sometimes. But importantly, the manager has to determine your status as an accredited investor, because again, we're talking about Reg D here. Reg D is designed for offerings of private securities, the exemption from the registration requirements, but the trade-off is that the investment managers can only sell to accredited investors. And so the subscription agreement includes a questionnaire where you have an opportunity to check a box and say, yes, I'm an accredited investor. But, note that there's a distinction between 506B and 506C, that the investment manager might be, if it's a 506C, it's available solely to accredited investors. And Sarah, would it shock you in a 506C offering if the investment manager asked you for information that would verify your status as an accredited investor?
No, because that's fair. Like, I can say whatever I want about my financial status, but in the end, especially if there's a critical compliance requirement for that manager, it's legitimate to ask for evidence.
Yeah, 506C requires it. If the manager is ever audited by the Securities Commission or the State Securities Board, that's going to be one of their first questions is, we need to see all the subscription agreements, and if you're doing a 506C to accredited investors only that allows for general solicitation, all the deals that we talk about on Alt Investing Made Easy, these are 506C deals, then the rule is that the investment manager will have to produce the evidence that he obtained from his investor to verify their status as being an accredited investor. And that can either be a bank account statement, a W-2, a tax return, but they've got the investor must establish by reference to third-party information, their fact of being an accredited investor.
I think there are even third-party verification companies that can do that now, that the manager can engage with, because some of this information is understandably sensitive, and sometimes it's complicated to demonstrate how you get to the thresholds for accredited investor status, particularly on a net worth basis. So I do think, there are different kinds of solutions over there, but it doesn't change the underlying principle and issue, which is this is very necessary for 506C.
Yeah, for sure. And I think investors are becoming more accustomed to having to turn over that information. But we've had 506C now for nearly I think 12 years. It was in 2013 when it came about. Maybe it was a little after that when the regulations finally got enacted. But in any event, it's a relatively new thing. But I think people have enough experience with it now that it's not a surprise that it's not just a check the box deal anymore.
Exactly. And one other thing about the subscription agreement that's important is that it sets out two important things. One, the amount of commitment that the investor wants to purchase, that has to be explicitly stated. So there's no confusion about what kind of commitment the investor is making. But these also have to be countersigned and accepted, right, Roland? So sometimes there are deals that are oversubscribed, and it's usually in the manager's discretion whether they accept an investment or not. So it's an important tool for avoiding any confusion or misunderstanding if an investor believes they've made an investment, but it wasn't actually accepted by the manager, or if there's, for some reason, there was a verbal discussion about different amounts of investment, and then what actually got put in the subscription agreement and followed up with a payment is a different number. This is the document that evidences the actual commitment.
Yeah, that's right. And the way we set up our offerings is the only document that the person signs, the investor signs, is a subscription agreement. They're signing that subscription agreement about their identity and their accredited investor status. But we always include in there, we say, your execution of this subscription agreement constitutes your signature on the operating agreement. But, like you said, it's not valid until it's countersigned by the manager. So this is your evidence of most times or almost all the offerings that we put together. There aren't, share certificates or membership interest unit certificates. The evidence of your investment is this countersigned subscription agreement, countersigned by the deal sponsor. Exactly.
Do you want to move on to talking about track record, Roland?
Well, yeah. Do you want me to start out, or do you want to go?
Go ahead.
Okay. Well, this is a favorite topic of mine, just because it has a really colorful metaphor, and we brought it up in the past. But this idea of how managers, there's a compulsion to think, well, I want to tell people how experienced I am, and what a great deal sponsor I am, all these great deals that I've done in the past. But you know what? I'm only going to tell them about the good deals. I'm not going to tell them about the bad ones. Is that reasonable, Sarah?
I don't believe so. I think that we need to hear the full story, or one might say the long story.
I'll tell you what the regulators say, and the regulators say that's actually a material misrepresentation. If I just come to you as an investor and say I've had one, unending string of successes and never had a failure, but I actually have had a failure back there, and I don't disclose the failure, then that's a material misrepresentation for me. Again, remember that materiality standard. So this is the metaphor is cherry picking. That I can't go back into my performance and just pick off those ripe cherries and say, here, Mr. Investor, Mrs. Investor, this has been my performance. But then those rotten cherries or whatever, or the ones that aren't ripe, however we want to continue the metaphor on, I'm not going to present the cherries that don't look delicious to eat.
Right.
But in my mind, there's no, I just heard our friend Trevor talking the other day, Trevor at Massive Capital, talking about there's nobody that's perfect. No investment manager is perfect. And if anybody's been in a business long enough, mistakes arise and deals don't go according to plan.
Exactly.
And so if you have an investment manager that is coming to you and say, yeah, we've done 20 deals, and a couple of them didn't work out, but we learned a lot from those. I think I would trust that person more because they're being forthcoming about the deals that didn't work out, but they're also telling you this is what we learned specifically from them. We're not going to make those same mistakes in the future. So that gives me more confidence. And again, it's, the demeanor of the manager, if they are getting offended at you asking questions, or if they're representing to you that they've never had any failures, boy, those are red flags,
Exactly. Yeah. Do you remember, we just recently spoke to Larry Powell, and also we're going to have another episode with him where he goes in more detail through his 10 tips for evaluating basically managers or promoters. In his context, it's advisors and investment managers, but the same idea applies here. And he likes to have people tell the long story. He wants to hear all about everything that they say about themselves as long as they can remember back to childhood. And that's the way that he gathers information about people. It may be that the long story isn't the fully necessary in a commercial real estate deal, for example, but the idea is exactly what you're saying, right, Roland? Is I want to hear about why you decided to go to that school instead of that one. Was, where you think you made mistakes. I want to hear about this good, successful deal, and I want to hear about when something didn't work out and what happened. So I like the term "the long story" because it kind of sets the mood for the kind of time you need to put into evaluating the track record of the management of the deal you're looking at.
The investment with the liquidity limitations on the private deals, look at these investments almost as a marriage.
Yeah.
And, you don't marry somebody or I guess sometimes you do.
Some
maybe.
people do. This is not a Vegas marriage.
Right. Yeah. But I mean, most marriages, that endure or are successful, I think there's, pretty significant consideration that goes into them. And so, you really do want to know the investment manager, who it is that you're investing with. You want to hear their story, asking for references to people. And of course, they're going to just give you the people that are going to say nice things about them. But if you listen to them long enough, this is what I loved about Larry, is that he could kind of triangulate, and he would say, oh, well, you worked at Bear Stearns. Well, interesting. I know somebody there. I can go to that person and get an independent verification of who the manager is. And so, think about that. You're interviewing this investment manager, and again, don't be afraid to ask questions and really listen to what they have to say, because people have a tendency, if you get them talking, we're talking about our favorite subject. My favorite subject to talk about is me. And so I'm just really enjoying this conversation because I get to talk about myself so much, and they may wind up revealing something to you that could suggest to you that this person may not be trustworthy, or they just mention in an offhand way that they work someplace and somebody there, and you call that person up and say, man, I haven't talked to him in a long time, but man, I always knew him as the most honest person, and here's some specific examples of his integrity. And so, it could go both ways, but anyway.
No, and it's actually also another opportunity to not just gather actual data, but also to form your own sort of intuitive feeling of a person. And that was something that Larry emphasized also, is that don't discount that. There's some anecdotal stories about famous investors and their physical or intuition and how they would sometimes make investment decisions. And so you can get into that in our episode with Larry, or one of the two. But it is an interesting, you need a little time normally to form a good intuitive opinion of something. You might be wrong, obviously, you might be right, but the whole point here is that you need to take the time and have a strategy when you evaluate the person that you're going to give money to.
Yeah, that's one thing that's come up in the presentation that we give is what are some key mistakes? And I brought one up. I thought about this, and I think that this is really true, is that people base their investment decisions purely on emotionalism. And that's not what we're saying here. I just decide to invest with somebody just because I like them, so really watch out for the bias, because know that the investment managers, even the best ones, they're trying to sell a deal to you, and good salespeople will tell you what they think you want to hear, just unconsciously. So
exactly. No, I mean, that's so true. So, Roland, should we get into some essential evaluation steps, or are you ready to move on?
Yeah, for sure.
Okay. So we just wanted to set out a few of the essential steps. We've talked about these specific details of the documents, and then the track record evaluation of the management. And there's also another factor there, which is deal flow, which is part of the manager's story and should also be their pipeline. That's, part of their investment strategy, as you discussed that with them. But basically, when you go through an evaluation process, there's a document review process, and you're going to have legal documentation. Those are the documents we just described above. You will also have financial statements. There should be some market analysis, particularly specific to the type of private security or type of category of alternative asset that you're dealing with. So it would vary if it's commercial real estate or a hedge fund or an oil and gas investment, obviously. And then you might want to do some background checks on people. And this is the process we already discussed at length when we're talking about evaluating the manager, but there might be other parties to consider looking into, such as a general contractor, other essential parties, who are there, who need to make the whole process, the whole investment work. So that would be in quick summary, what a document review process would be, those documents. And then, of course, you need to get the necessary advisors to support you. If you don't feel that you're yet ready to make a lot of decisions on your own, then seek support from your community. You can always have legal advice, financial advice, accountant advice, etc. And then also industry, finding out information from the industry, et cetera, and through your network is a way to go support assessing all of this information.
It's good. Yeah, the documents are important, and just evaluating, if there are a bunch of grammatical errors or typos, that can reveal something to you. If there are things that are left out, or like you ask for a copy of the operating agreement and they perpetually refuse to provide, or say, oh yeah, we'll get that to you next week,
Right, exactly. No, this is all the soft things that happen around, like we mentioned at the beginning, right, Roland, the soft things that happen when you're in the process of asking for information, when you start to find little hurdles or blocks or, doors that are closed. It's that in itself is a lot of good, useful information. So let's see, in terms of essential evaluation steps, what do you think, Roland? We talked about the management assessment, their experience, doing your reference checks, the track record verification to the extent that you can. And then one thing we didn't mention was, you want to have an understanding of how that manager has a team that supports them, because there's a key man issue with some of these types of investments. And that is, if the one manager is excellent at implementing his hedge fund strategy, for example, but what's the plan if there's an unfortunate accident and that person is no longer with the project or with the fund? There needs to be a team that's underneath that person to step in and keep things going, or just, step in and keep them going in a great way, or at least wind them up.
Yeah, I think we should really pause here, Sarah, because this can't be overemphasized. I think, like you invest in a company like Microsoft, and they've got how many employees? Probably in excess of, tens of thousands. So the death of any or
one person really doesn't impact on the whole organization.
Yeah, no, that's right. But I mean, we're working on some of these deals. It's small business, so most of our deals will have some redundancy in the management, but But I'll have to say, I've done a ton of deals where it's just one guy putting it together, and he has a team of people around him for sure. But, one of the classic risks is we're heavily reliant on our management team members, and the loss of any one of their services could have a material adverse effect on our performance. And so that's a common risk in these small deals. And I think a real reasonable question for you as an investor to ask is, hey, Mr. Manager, Mr. Deal Sponsor, it's the classic question. If you're crossing the street and get hit by a bus, what happens to my investment? What happens to the deal? Who's going to step in and make sure that I don't lose all my money?
Exactly. And some of the good examples of how a promoter or manager will address that question is to just bring it up first and say, I know I'm of a certain age. Here's my plan. Here are the people who would step in, et cetera, et cetera. And that, builds the trust and transparency that we keep talking about with managers.
Okay, well, that's good. Then can't emphasize that enough. The team, before we move on, I wanted to mention the team dynamics, because this is we do represent open-ended funds. For the single asset syndications, you can assess, okay, they're raising a specific amount of money for a specific deal, and this is how they've got it staffed, and this is how they're going to do it. So it's maybe easier to assess there whether management is sufficient for the single asset syndication. But sometimes people will come to us and they'll say, you've heard the question before, Sarah, I want to do an open-ended fund and I want to raise $100 million for it, and so we've got, $10 million projects that we're going to fund with the investment dollars. And somebody saying that, they've probably thought through this question, but sometimes people will ask, well, how much should I authorize? And the answer is, how much can you handle?
Yeah.
For the hedge fund manager, they may be running a strategy that is not scalable beyond a certain size of fund, because they don't have the adequate personnel to manage that much.
Yeah,
and
exactly.
So that's an important question to ask, and just does the management team, are they adequately staffed to faithfully steward the total investment that they're going to be accepting?
Exactly. That's really important. Roland, we didn't talk a lot about investment strategies, and maybe that's the subject of a different episode that we're going to do. But just briefly, another part of your evaluation process is the investment strategy. Sometimes it's a simpler strategy. Sometimes it's a more complex strategy. We used it as the example of, management maybe needing to protect proprietary information. But overall, features to consider when you want to discuss an investment strategy would be what the market opportunities are, or specific opportunity, where there's a competitive advantage for that particular deal or that manager that they've identified that differentiates them from other similar projects. Of course, risk mitigation, which involves some risk evaluation we'll talk about in a minute, and then what their exit strategy is. I think on a commercial real estate deal, there's usually a fairly structured or clear exit strategy that has to do with time it might take to develop the property or various factors. So those are some things to consider. But Roland, I think we are planning to do an episode specifically on these in due course.
Yeah. And again, this is the idea here is that you should be understanding what the manager is doing with your money. You should be able to understand that through what they're disclosing to you. And they don't, sometimes the investment strategy will go on for pages, or maybe that'll be more in their marketing materials, but just making sure that they're telling you enough so that you understand what's going on. And this is something that's worthwhile noting, Sarah. This is something we include in all our documents, right? That the manager will say, if it's not a single asset syndication, if it's more of an open-ended deal or a hedge fund, the manager will say this: the manager retains discretion to implement other investment strategies not disclosed herein if it determines that it's in the best interest of the fund and all the investors. Exactly. As long as the manager is satisfying his fiduciary duty, he's disclosing up front that he has the authority to change the investment strategy. And so that's normal. I would want, if I'm going to be invested in something that, where my money's going to be tied up, at least for whatever an initial couple year lockup period. I want to know that the manager can make changes if he needs to, but he's not going to do anything that is stupid. And importantly, he has the fiduciary duty to look after the fund and the best interest of the investors and not just his own best interest.
Exactly. You need with changing market conditions, the manager needs to have agility. But this also, I think, speaks to the relationship you cultivate while you're going through the process of understanding all of these things. In a good situation, a good investment manager will be wanting to communicate changes in their strategy, will be making an effort to make sure people understand, his investors or her investors are understanding what's going on, so that she can, bring everybody on board with her, because she wants to be successful as much as everybody else, not just from the ability to earn carry or fees, but, potentially she has her own assets tied in with the same investment. That's actually a good situation when she has her assets tied together with the assets of or she's invested in the same way as her investors, then she can, she has the same interests as them along, when wearing that hat. So this is an area where communication is important. Let's see. Moving on to risk evaluations and just being mindful of the time, because we want to try and keep these digestibly a bit shorter than some of our other episodes. And risk evaluation is something that we've talked about before, and I think we'll talk about it again, Roland. I think we have another episode planned for that. But just briefly, you want to just name the main kinds of risks that we encourage people to consider when they're looking at investments?
Yeah, market risks. What is the market, and how could the market change to make my investment, put at jeopardy? And there will always be a risk factors section in the private placement memorandum, and so going on, let's see.
We've also got operational risks.
Just sort of disappeared from the outline.
Oh, sorry. I just messed with it. That was me. Everyone, that was me.
So I know the next one was liquidity risks, and maybe you could paste those back in where they were before, Sarah, so I can see them. But liquidity risk is something that we always talk about with the private securities deals, because again, these are associated with a single asset that has liquidity constraints, or in a fund that'll have a lockup period. So these aren't investments where you could just log into your online brokerage account and sell them. I'm not seeing where the rest are, but like we said,
I can just mention them. We've got operational risks, financial risks, and regulatory risks. So these are all should be disclosed in your private placement memorandum. And if it helps you to, when you're assessing them, or when you want to establish if those risks are comprehensive, to understand that there are about 5 categories at minimum of the kinds of risks that you should be seeing.
Okay, well, that seems like a good place. I know we want to keep this to a digestible length for our audience, and we'll come back to these topics in the future for sure.
Right.
But hopefully at the end of this episode, you've gotten an idea of what some of the documents are, and how you should approach evaluating the documents when you're considering an investment in private securities.
That's right. So thanks everyone for joining us on Alt Investing Made Easy today. If you like this episode, please like and subscribe to our channel.
And we do want to repeat that we're available for free consultation. We're practicing attorneys, and we can speak very intelligibly about any of the things that we talked about today, or on any other episode of Alt Investing Made Easy. And then our sign off now is this: remember, everyone, take aim with your alternative investing strategies.
We'll see you next time.